Let's go ahead and get started. Thank you very much, everybody, for coming to the first SEAC meeting, the School Employer Advisory Committee meeting of the new year. My name is David Takearts. I am a manager in stakeholder relations at CalPERS, and it's my privilege to be the moderator for the CalPERS session of this meeting today. Last year, if you recall, the meetings were at CalPERS and we went in the afternoon. This time, just to keep things spicy and interesting, this year it's going to be at CalSTRS with CalPERS going first. So, nice and stimulating for us here. The information updates this morning will be provided by CalPERS staff. We've got a packed agenda, which should be in the packet, which you've picked up. If not, those packets are available to the side. As you can see, we've got a varied and wide agenda, so we're going to move briskly along here. As usual, the SEAC meeting is being webcast to those of our colleagues who can't be here in person today. So to accommodate them and to make sure that their experience mirrors our in-person experience to the extent that it's possible, any questions and comments, please wait for our mic runners to come and provide a mic. So in the back we have CalPERS staff Merle Foley-Love and Joshua Robinson who will be able to bring the mic to you. I assure you, if you just ask the question or make the comment, it's going to be very confusing to the folks on the webcast. They won't hear it. All they will see is a person kind of nodding their head as they listen and then responding to apparently nothing. So give them just a moment to bring that mic, and then the folks on the webcast can hear it. This room itself is big enough to where if somebody over here is asking a question without a mic, probably even the folks in the room can't hear it. So let's make sure that we keep that in mind. For those of you on the webcast, welcome as well to you. If you have questions that you would like answered, please feel free to send an email to a special email inbox that we have set up. That email address, if you're ready, is CalPERS_SEAC, S-E-A-C, at calpers.ca.gov. Okay, so that's CalPERS_SEAC at calpers.gov. Go ahead and email a question in there. I have staff back at our office who will be monitoring that email box, and then they will forward me the email. So I have my iPhone up here where I'll be able to check those emails. We may not be able to get that question answered in real time, but we are going to be taking a break at approximately 10:45, and I'll have time to really go through the emails at that point, and then we'll make sure that those questions are asked to our CalPERS staff at that point. Okay, let's go ahead and dive into our agenda. Up first today, we have a special appearance by the CalPERS Chief Financial Officer. Her name is Cheryl Eason, and she's going to be sharing an update on GASB 68 and other financial matters. Please welcome Cheryl Eason.
Thank you. Good morning. And David mentioned, thank you, David. He mentioned about spicy information. What could be more spicy than GASB 68? So I want to provide you with a very quick update on the new standards. Probably most of you are aware that GASB 68 is a requirement where we need to provide more pension-related note disclosures and required supplementary information to our financial statements. And that is effective, that standard is effective for fiscal years beginning after June 15th, 2014. So for most of employers that we deal with in the CalPERS plan, that would be for the fiscal years ending June 15th, 2015. So very close upon us. I think the key thing to remember is that under the new standard, our accounting and funding are not the same values. They're not the same when it comes to reporting. The net pension liability that we which will now be recognized on the balance sheet is new under this standard. The pension expense is calculated differently. It's no longer equal to the annual required contributions, or what we refer to as ARC. So those, from an accounting perspective, when CAFRs are being produced, that's important because for the school employers, that information has to be provided by our CalPERS actuarial office, who is working on that valuation. So those normal funding actuarial funding valuations that we normally provide, we can't use that information for accounting purposes. That's really what the new standard does. I think it is important to note, we get this question all the time, that the financial statement information that now has to be provided under GASB 68 does not change the actuarial method or the assumptions that are used in the actuarial valuations. So the unfunded liability that's being reported in your valuations does not change. And I think that's just very important, fundamental point to always keep in mind. So what is CalPERS doing in terms of assisting? Well, we are compiling information to be able to provide to the school employers in the development of this required information under GASB 68. And your school employers are considered to be cost-sharing multiple employer plans. So what that means is that the school employers are required to report their proportionate share of the net pension liability and the pension expense that I talked about. So the information that our actuaries are currently working on, and we believe will be available in the spring timeframe, so we're sort of targeting for April, means that they're going to be able to provide that information, come up with that net pension liability number and that pension expense number, and we're going to make that available online. The other thing, in order to understand what the proportional share is, we also have a methodology under the standard that we have to apply. And we've reached out actually already to the school employers and asked them for what their contributions were, their annual contributions are. Because it's based on the annual contributions that we're going to determine what your proportional portion is. So the actuarials will give us the information for the financial reporting. You'll apply your proportionate share of that total liability is, and then that's what's going to go into your financial statements. We're also providing that in an audited form, in that we have engaged our external auditors to look at that information and make sure that what we're giving you is appropriate and accurate for your financial statements. And of course that's important because that's the assurance that your external auditors will be looking for when you receive that information, because that information now goes on to your financial statements. So we actually have a web, you can call into our call center. They will route your call to our financial area. We have a financial reporting area that are all knowing and all seeing about GASB 68. I forgot to mention Kristen Montgomery is the controller, and so she oversees the area that if anybody has any questions, we have staff that can assist. And we've also set up, there's also specific questions that can't be answered either through our frequently asked questions on our website. We have a section just in our website for anybody that has questions about GASB 68. We also actually have an email address as well. If you go onto the website, you'll see that. You'll see on the website there's a section where circulars are, any circulars that we've sent out, any information that you need on GASB 68, and then of course reach out directly to us. We'd be more than happy to answer your questions. One thing I want to mention, we do have a circular that is coming out that will pretty much cover what I've just talked about, but I did want to let you know that when the information is available, based on that, each school employer will have to apply their proportionate share, as I mentioned. There is a cost associated with this preparation and audit work. It's the cost we've estimated to be $350 per school employer. That will be a separate invoiced cost. The cost associated with the external auditors coming in and providing the assurance on that information does need to be passed on to the school employer, and so the most efficient way for us to do that will be through an invoice amount. So, but all of that information, there is a circular coming out on that. And as I said, all the contact information is on there as well. We do plan to do a webinar as well in the May timeframe. But of course, if you need any of us to come and talk to your staff individually, to your finance areas, please do not hesitate to call. We like to provide that information, and we'd be more than happy to help you. And I know it's sometimes very helpful for us to be able to be there. We can certainly walk you through that. We can also assist in walking your external auditors through that as well, if they have any questions. So I'll stop there. If Kristen and I are quite happy to answer any questions if you have any. There's a question here.
We need the mic.
I'm Veena from Orange County. My first question is, so you can tell I have more than one, is that our county offices received some kind of spreadsheet of the numbers, and those numbers we couldn't figure out how you arrived at it. Can you explain us a little bit how you arrived at those numbers?
So what we provided to all of you was the numbers that came out of the CalPERS system. So when you're reporting in your payroll information, that's what we used. I think the biggest question was there was some adjustments. So we can go in and we can reconcile because there was adjustments that happened after our fiscal year end closed. That will be the difference. So if you reach out and you send an email to the email box and say, okay, I cannot reconcile it, we'll work with you to make sure that the adjustments, because that's what we found out, and I learned it from some of my friends at some other meetings. It's the adjustments that came after our year end close. So just go ahead and send an email to the email box and we will reconcile with you because we have those numbers.
And I didn't quite understand about the cost 350. Can you explain that one more time?
Sure, you want me to? Or, yeah. Okay. So what we have to do is our trust, PERF, is a qualified trust. Therefore, we cannot, the work that we're doing for GASB 68, we cannot charge to our trust. So what we did is we looked at the incremental costs of what it takes to provide the information to you as the schools. So with the reports we're doing, the allocation that Cheryl talked about, providing you the net pension liability, the net and the expense, and then the audit. And we looked at what are those costs, and that's how we got it. And it was $350 per school employer, and that's how we're charging.
That means the county office will have 350 and we?
It depends on the employer. So if you have a county office and you have a bunch of school districts in there,
Yeah.
it's by that.
No, I mean 350 each district?
Each district, yes. Yes, and the issue is the auditors have to audit by school district. So that's what they're doing, is they're going through and they're making sure that all of the school districts have the correct allocation, the correct net pension liability. The other thing is, when you guys do your financials, it's by the school district. So your external auditor's looking at that from that point too.
So once a year, let's say we have 40 districts, 350 times 40.
Yes, that's correct.
And once a year, the invoice will come.
Yes, yes.
Okay.
I
Thank you.
think what's also important, thank you for those questions. I think what's also important is when your external auditors come in, it's important that you explain that CalPERS external auditors have looked at that information, because that then allows them to rely on that information. And it means that they don't have to do that work, they can rely on that work.
Francis from LA County. How soon do you expect the circular to be out?
For the cost, that is, I'm hoping this week. This week.
This week.
I'm hoping this week, yes.
Okay, on the contributions, is it the contributions remitted or the contributions reconciled to the report submitted?
So what we need to do is GASB 67 that we implemented has to tie to the GASB 68 information. So it will be our information that's in CalPERS when we closed. We still want to reconcile because there may be some differences, and that's what our auditor's looking at to say, hey, there's some differences because of the adjustments came in, so that they can give that information then to your external auditor that says, hey, how come it's not tying to your books? So we've already done that work for you.
Okay.
So it's really our information that's in the CalPERS system at
But
that
based
point
on
in
a
time.
file that's been submitted.
Yes.
So if we have files that are in suspense,
They were not submitted.
they were not submitted.
Correct.
Okay.
And that's why it's really important that your data, whenever you're doing that at year end, and this is something we're going to learn for next year, we want to get that payroll information in. We want to clear those suspended files. It's really important now. There's a motion behind it.
Ellen Yu for Riverside County. I just wanted to ask, when you send that invoice for $350, are you going to send, let's say if there are 20 districts, 20 invoices, $350 each, or you're going to send combined invoice to the county office and specify which districts?
So we're working on this right now. I think it's easier for everyone involved that we send one to the school district and then have each of the, or one for the county and each of the school districts inside of there. So you'll get one invoice if you're a county district and it'll detail each school district inside there. Okay. That's what we're planning to do because we are unfortunately kind of doing this manually. So, and I know that you guys, I've gotten feedback from all of you, some of you to say, can we have one invoice with the different school districts in there? And so what we're doing is looking at how you supply the information to us. So if you, as a county, let's say, for example, Orange County, if you have 40 different school districts you report to us, we would give you one invoice with 40 on it. That's how we plan to do it.
So, and the first invoice which we will receive will be this fiscal year?
Yes, it'll be this fiscal year, and it will tie to when we produce the report, so around April timeframe.
And it's each year around April we
Each year,
should
probably around
expect it.
April, yes.
Okay.
There's a question over there.
Hi,
Okay.
Teresa Cooper from Stanislaus County. When you send the invoices, what about the independent reporters? Are you going to send the invoice directly to that office, or is that coming to the county office as well for us to forward to them?
It'll be based on how you send the information to us. So if you have an independent reporter, meaning the payroll comes in and we have contacts inside of our CalPERS system, it'll come from that. That's what we're using, because that's all we know is how you're reporting the payroll. That's how we're going to invoice you,
Okay,
that way.
and then charter schools. We report them as separate unit numbers or whatever their number is now called.
Separated.
So
yes.
each one of those will
We'll
be
get an
billed the
invoice.
350.
Yes. So.
I think that may have been my same question. As community college district, we're doing our own reporting directly and our own payments directly. So we should be receiving not only the lists and the reconciliations, but also the invoices directly.
Yeah, you would receive it in, your invoice will be sent to you separately. The way you're gonna get the reports though, we're probably gonna put those on the CalPERS online because it's really a pool. So you're gonna get a pooled report. So we will be getting the pools with your allocation.
And we'll have access.
And you'll have access to that along with the auditor's opinion.
Great.
So you'll be able to pull that off of CalPERS online for schools.
I'm sorry. When I was listening, the way I understand, the first invoice will come in April of 2015.
Yes.
But numbers are not available at that time, or they will be available at the same time.
That's what we're
What if
planning.
any district doesn't want your number? I'm just checking. Can they refuse to pay?
What was that?
I'm just
Well,
checking.
yeah.
But if any districts doesn't want your number, let's say there is only district with one employee. We have a district with 1 or 2 employees. So why would they pay $350?
Again, it's based on your financials and putting your financials together. If they don't produce the financials and they don't want our number, I think we need to work with you to figure out, you know.
I
'cause
was just curious.
we don't know that you're not going to do financials. We figured that every school district has to do that. That's the
Yeah.
assumption that
I'm
CalPERS
just
is making,
curious
yeah,
to
so.
understand. Thank you.
Yeah, I would just add that if you do produce financial statements, your external auditors will be asking for that number, so.
Yeah.
Great. Thank you. Thank you very much for your questions.
Thank you very much, Cheryl and Kristen. All right. Our next speaker is CalPERS' own Danny Brown from the Legislative Affairs Division. Thanks, Danny.
Good morning, everybody, and I'm assuming after listening to GASB and legislation, the rest of the morning is going to be boring. You guys are just going to get all the excitement here off at the beginning. So on legislation, I will kind of talk probably about three different things. First is we are sponsoring some legislation this year. I don't think it's really has any direct impact to the school districts. We have a housekeeping bill where in that bill we'll be modifying or eliminating one investment report and modifying another investment report. The one area where it's kind of dealing with members is for service credit purchases for leave of absence. There's a couple of them, maternity and paternity leaves, and serious illness leaves where the language is a little bit different than the other ones. And so we just want to clarify that if you go out on one of those leaves, you have to return to state employment in order to buy that leave, and you also have to make that purchase before you retire. So again, it's just consistent with how we administer all of those leaves, and no change really there. The other legislation we're sponsoring is actually co-sponsoring with CalSTRS, and again, it's investment related, so I don't think it's a direct impact, but we're looking to clarify that some of our investment contracts with external managers don't have to go through the state contracting process, that the board can develop our own process. It allows us to be more nimble. Many of these contracts are overseas, a lot of things going on, and so the state contracting rules really don't apply for some of these contracts. So those right now are the only two bills that we will be sponsoring. Again, I don't think it really has a direct impact on your day-to-day work. You have the list in front of you, I think, or in your packet about the legislation. As you can see, there hasn't been a lot of bills introduced. Yesterday, you may have saw the Senate Democrats had their California climate package that they introduced. And it did contain a bill to require CalPERS and CalSTRS to divest from coal companies. So we'll be working with Senator De Leon and figuring out how best to structure that bill so it doesn't have a huge impact on either of the systems. I think CalPERS, it's important to our board around climate risk. I mean, it's one of the things that we are working on in our investment office as a global long-term investor. Obviously, we're concerned about climate change and how it may impact our investments down the road. So it's something that we are engaged in. We're working with a lot of other investors, talking with fossil fuel companies, making sure that they're looking at climate change, they're reporting on climate change, they're thinking about their business model. So it is something that we're engaged in. Obviously, divestment isn't our number one choice. We always want to be engaged and have ownership so we can engage these companies. So we will work with Senator De Leon on that bill and see where it ends up. The other thing that we're working on is the trailer bill language that's out there. If you watch the governor's budget, his big thing as far as state employees is health care. Again, as of right now, it's hard to know whether or not it will impact school districts. There's always the saying that whatever happens to the state will eventually roll down to school districts. So I know some of the school district folks or the lobbyists that deal with school employees are watching it closely. But if in the trailer bills, there's kind of broken up into two sections, as I would say. It's one that's really trying to drive down healthcare costs, which I guess would impact you if you're contracted with us in PIMCA. How many people here are in PIMCA? Well, just a few. So how many of you are, even though you're not in PIMCA, you provide retiree health care to some way or somehow? Okay. So one portion of it is kind of dealing with PIMCA and trying to bring down those costs. They want a lot of information from us. They want us to provide a high deductible health savings plan to try to bring down cost. The other things that they're doing, which really right now I think is geared towards state employees, is they want to change the vesting schedule for new state employees. Right now, a state employee has to work 10 years to get 50% of the employer contribution, 20 years to get 100%. They want to change that to 15 and 25. They also want to change how much the employer contributes at retirement. Right now, actually, retirees get more than active employees. So they want to change it so that retirees don't get more than active. It's either the same amount or something less than you get when you're an active employee. The other thing they want to do is start pre-funding the retiree medical. So they're using this much like in PEPRA, where they said all new employees have to pay half the normal cost. They've put something in there that says, it's our opinion, that declaration that all public employees should pay half of the normal cost for the retiree medical. So that's where if you do provide retiree medical, there may be pressure, or there may be going down that road where they're going to want you as the employer and your employees to start pre-funding that and putting in half, paying the full normal cost. You would pay half, the employees would pay half. So it's something that he's indicated that he'll start negotiating with state bargaining units. Right now, CHP already puts in quite a substantial amount into a pre-funding vehicle, actually into our trust fund. And bargaining units, I believe 12 and 16 put about 0.5% of payroll into a trust fund. So it's something that he's going to start bargaining with his, when the collective bargaining agreements come up, to start putting that money aside. So again, I think all of this stuff right now just applies to, appears to apply to state employees. It'll be interesting to, later on this afternoon, what Mary Ann has to say and whether or not she's had any discussions with Department of Finance or the administration to see whether or not any of this would fall onto school districts. But I know that sometimes whatever happens with the state eventually gets, could happen to school districts. So I will stop there because that's kind of all that's happened so far. I'm not hearing about any other bills out there that may or may not come as far as that will impact pensions. So unless there's any questions. Oh, I can't believe you had more GASB questions than legislative questions. I'm really hurt. I'm really hurt. So, okay, well then I will turn it over to the next person.
Great, thank you, Danny. Okay, a quick note to the folks on the webcast before we move on, please. We're having a little bit of technical difficulty with the CalPERS_SEAC inbox. So I'd like to ask you to please just email me directly. My name is David Takearts. The spelling appears on the agenda under CalPERS update and welcome introduction. So the email for that would be David_T as in Tom, EYKAER, T as in Tom, S as in Sam, at calpers.ca.gov. So on a personal note, I just got married a couple months ago to a gal who actually used to work at CalSTRS, and her last name is Driver, and she agreed to take my last name, and every day she complains to me about how every single phone call to every bill or provider, she has to spell out the last name because nobody can sound it out. She's like, if I could do it over again, I would keep my last name. Too late. Okay, legally binding, done deal. All right, so let's move on to the next agenda item. This features my favorite speaker, David Takearts from CalPERS. That is me. So, as the moderator, I reserve the right to put myself on the agenda. So what I'd like to do is give a brief CalPERS update, kind of like piggybacking off of a little bit of what Danny was saying. I would like to just take a moment and just talk to you kind of about the state of the system a little bit. Not everything will directly relate specifically to school employers, but I venture to guess that most people are at least somewhat interested in, okay, well, how is the whole structure of PERS doing right now? Are the pensions safe? Like, what are some of the hotter topics? What are some of the issues confronting the system at kind of a higher level a little bit? So I'd like to take just a few minutes to go through this, and then I'd be happy to answer any questions afterwards. So, leading right off, recently we've had some turnover on our board. I'm not sure how many folks are keyed in on this. For example, the representative, the recent board race for the school presence on the board was uncontested. It was Rob Fechner, who is the president of the board for CalPERS, and he ran unopposed, and so won in a landslide. We also had some movement. We had the former state controller, John Chang, won the election to be state treasurer, so he moves from one seat on the board over to another seat. Both of those positions have automatic board seats for the CalPERS board. The new controller who was voted into office is Betty Yee, so she's beginning to serve now. I believe this next session will be her first official formal presence on the board, and our board week is next week. We also had Richard Costigan reconfirmed as a board member, and Bill Slayton from local government. And then our new board member, though, is Teresa Taylor, filling the vacated role for the active state member position, which is being vacated by the now retired George Deere, who served for well over a decade on the CalPERS board. So we've had some movement. But we're set for now. Next year, we'll have the retiree position will be open for elections. This is one that's not assigned. We have a combination of elected positions where basically the constituents, either retirees or state members or school members or public agency members, can vote. And then we have some that are appointed automatically, like the treasurer, like the controller, where if you were elected by California as a whole, you get that position. So it's always kind of a exciting time there with the board governance, or rather the board election process, but we're set for now. Two other issues that often come up are questions about the municipal bankruptcies. If you read the Sacramento Bee in particular, I mean, any California newspaper, these are often big issues, so I wanted to address these, give you the latest and greatest news on this. So with the Stockton bankruptcy, this one has been going on for about 2 years now. The city of Stockton officially filed for bankruptcy 2 years ago. And right from the get-go, the city always indicated that they were not going to try to what's called impair their pension obligations. Okay, so even though they were looking to declare bankruptcy, which would reduce how much they have to pay to various creditors, there was no desire from the city to say, okay, we're going to not make our CalPERS monthly payments. Okay, because city employees of Stockton are part of the CalPERS system for pensions, not for health benefits. They are not part of our health benefits plan. That's an important note. So they compromised and took a reduction on how much contributions the city makes for health, but the pension with CalPERS remained untouched. They forwarded a plan to their bankruptcy court to say, okay, we would like to declare bankruptcy, but we're going to maintain our pension payments. One of the creditors, and a city has many creditors, they take out many loans in the form of bonds to fund things like building of parks and bridges and things like that. One creditor was pretty obstinate. This is called Franklin Investments, and they basically were making the point that, hey, we don't want to be paid back pennies on the dollar when CalPERS gets paid back in full. And so this was escalated through the courts. The judge kind of presiding over this issue made a verbal or an oral statement that he, in his mind, did not see a particular difference between pension debts from a city and debts to other creditors. So that was an official opinion that the judge rendered. In this particular scenario, it had little consequence directly because the city of Stockton was not trying to sidestep its CalPERS payment obligations. So the judge said, technically, I don't think that there's much of a difference, but City of Stockton said that, well, we fully intend to honor our pension obligations, and they have not missed a payment. So that's kind of where that stands. The recent wave on this was that Franklin wanted to appeal, saying, no, we want our money. But the judge overruled that. Recently, the judge put into writing his verbal opinion, and so that made a little bit of kind of smaller headlines, but there was no new information. Essentially, the judge is just saying that in his opinion, there's not a difference between pension debt and other municipal debt. So that's kind of where that stands right now. So Stockton is proceeding with bankruptcy. Their plan of adjustment, as it's called, the plan of adjusted payments to creditors, is continuing, and there is no jeopardy of them not making their CalPERS payment. Now, the other city that kind of comes into this discussion, the other California city at least, is City of San Bernardino. And City of San Bernardino was a slightly different situation where there were several months where they did not make their CalPERS payment. And so they then entered into closed-door negotiations, which had a confidentiality stamp on it. So I literally don't know what was going on in those agreements, but the result has been a resumption of payments. So City of San Bernardino, similar except that they missed a couple payments. They've now resumed making their CalPERS payments. They've resumed their commitment to honor the pension promises made to their public employees. And my understanding and what's been released is that there's a negotiated agreement to go ahead and back pay for those missed months. So sort of like if you miss your credit card payments, kind of like the interest just kind of racks up a little bit and some late fees, but you can then just continue to pay that down after the couple of missed months. So that's where we are with municipal bankruptcies. So both of those cities are making their payments, and we continue to kind of make the main push from CalPERS is that it's important for our employers, okay, which in this case is cities, but it would be the same were it school districts and school employers and county offices of ed and the state itself, state agencies, is that the employees of those areas entered into service with the understanding that they would have a public pension waiting for them at the end. That was part of the contract, that was part of the deal, and CalPERS wholeheartedly supports that, believes in that, and will continue to fight for the defined benefit plan format of a pension from now until the end of time. Okay, so that was a little editorializing at the end there. That is definitely the push, though, is to maintain those pension obligations. Moving into some other business, we have something called the Dependent Eligibility Verification Project going on. So I just saw a show of hands that almost no, but there's one or two hands went up for how many of your schools or districts are part of the CalPERS health family. I only saw a couple of hands, but just to let you know that we're, as a system, doing our due diligence. We've been running kind of like a multi-phase program for over a year now to eliminate people who are getting health benefits who should not be. Essentially going back and saying, okay, some people may have slipped through the cracks. It's very commonly divorced spouses. So somebody was married to somebody who was in the system, they got divorced, and now 15 years later, that divorced person is still receiving our generous health care on the taxpayer's dollar. So we're like, no, that really should not be occurring. We're not gonna pay for your free health care. And so we've been doing a massive cleanup of all of that. And to date, in this year, in the last 12 months, CalPERS has saved more than $106 million already on that. So this was no small potatoes. It was quite a massive thing. We've removed over 15,000 ineligible dependents. I mean, this is quite an undertaking, and so this is ongoing. We're nearing the final stages now, and I'm excited to see what that final number is. I mean, literally every day we're saving hundreds of thousands of dollars and eliminating, incorrect, benefit payments there. And then lastly, I wanted to let you know of an ongoing project at CalPERS called our Risk and Risk Mitigation project. Risk in this sense is referring to risk in the system itself, meaning the risk or the likelihood that over the next 20, 30, 40, 50 years down the road, what is the risk that CalPERS may not be able to pay the amount of pensions that we need as counterposed with how much money do we need to take in to pay that out, and how much money do we need to make via our investments? Okay, so in a combination between our financial office, which was Cheryl and Kristen, who you just met, and our investment office and our actuarial office, basically get into a room, get out their computers and calculators and say, okay, we know that in the next 30 years, we are going to need X number of dollars in order to pay out X number of retiree pensions. How much do we need to take in from employer contributions, from member contributions, and from investment earnings? How much do we need to take in to be able to pay that out? And they factor in all kinds of things. One of the most startling things that has kind of highlighted this possible risk is the ratio of active to retired members. So 10 years ago, there was almost 2 active members, meaning people who are currently employed, currently paying into the system out of their paychecks. If you take a look at your paycheck, you're paying in however a couple hundred or more dollars a month into the system. 10 years ago, there were 2 actives for every person drawing a pension check. So 2 actives for retirees. Right now, it's almost 1 to 1, and in 10 years, there will only be between 0.6 and 0.8 actives for each retiree. Okay, so there will be more people retired and drawing a pension check and contributing nothing into the system than there will be people actively working, contributing into that. Okay, very similar kind of to the dire forecast about Social Security, right? It's pretty much the same thing, and it has a lot of the same drivers. An aging workforce, people getting close to retirement, and then less people being hired because of the costs and associated and other factors like that. So basically, our brightest minds are working to remove that risk. Basically, say, what can we do? What are the things that we can control? Is it about making bolder investments? Okay, to produce more money? Or is it about making investments that are actually more conservative so that there's almost no chance that we'll lose on those investments in the future? And then many other things as well. What can we do about the retiree rate versus the hiring of new people rate? And just literally dozens of other factors as well. This is a very complicated science. And so this is the work that's being done right now. We actually have an open public workshop on this next Wednesday as part of our Pension Health Benefits Committee at the CalPERS board, where the kind of like the curtain's going to be drawn back on how these numbers are crunched, how this works, and like putting out, we have five kind of strategies that we think represent the best way to, or five best possible ways to reduce that risk. Those are going to kind of be discussed and unveiled, pros and cons, deliberated. So it's really a chance to see how the real meat and potatoes of retirement security is developed and protected. So it's very cool. If you can't make it in person, there's of course going to be webcast. I'm all geeked up about it, as you can hear right now in my voice, but it's going to be very fun. So that's kind of like the ongoing work that we're doing right now. So I can assure you that the system itself of pension, the ability to make pension checks happen forever, okay, for the next generation, the generation after that, 50 and 100 years down the line, that's the work that's being done at CalPERS right now. Okay? In addition to all of the day-to-day work of, submitting payrolls and how do we do actuarial evaluations for individual districts and other employers, we always have that bigger scope as well. So that's some of the work that's being done. So you can tell we've got a lot going on. Questions on any of that before we move into the nitty-gritty of doing this work? Just dazzlingly clear, I see. Okay, then let's go ahead and move forward. Next on our agenda, we have Mr. Brad Hansen with an update on new changes in 2015. Brad, come on up.
Good morning. How's everyone doing today? Good. Good to see you all again. Yep. All right. So I have a hodgepodge of about 3 or 4 different topics we're going to talk about today. Most of them are for the 2015 calendar year. And many of them we've actually spoke to you guys about at the last SEAC meeting or at the Education Forum or other venues as well. But they're always good reminders. So the first thing I wanted to discuss is the 2015 IRC limits. I've gotten a lot of calls lately about where's the circular letter for the 2015 limits. We actually drafted it up. It's going through a new process of approval for a circular letter, so it takes a little bit longer than in the past. But it should be coming very soon. I heard in the next few weeks it should be mailed out. But to give you guys all a sneak preview of what these new rates are, we have them up there on the board, or on the TV, I should say. For Classic members, it's going to be $265,000 for this calendar year. For the PEPRA new members, if they have Social Security, it's going to be $117,020. And without Social Security, it'll be $140,424. And just as a reminder, this is something we changed actually 2 years ago. Now, once that limit's hit, when the earnings reaches that limit, contributions should stop for the rest of that calendar year and then pick back up on January 1st when the new calendar year starts. A common question we get about the IRC limits when you report biweekly is how do you report that biweekly report when it goes over the calendar year? So like you have a schedule that say December 26th through January 8th, something like that. The proper way to do it so that you capture the contributions right would be to do a report, your earned period report from December 26th to December 31st. report it with 0 contributions, and then do an adjustment report to follow it up for the remainder of January with the contributions. So that's a common question that we get about these IRC limits. We are looking at enhancing the system so you won't have to split the reports in the future. We're targeting to hopefully get that done by the end of this calendar year. With our system, we have so many different things we're trying to prioritize, and sometimes certain things we get prioritized over the payroll parts of it, but we realize this is kind of a burden on employers, so we are trying to push it for the end of the next calendar year. Okay. Next. This is something, too, that we talked about at the last school advisory meeting, getting a lot of questions about it. A lot of employers, I'm not saying school employers necessarily, but a lot of employers were kind of blindsided by the fact that this government code was changing. So as of January 1st, there was an assembly bill. It's AB 2472. It basically states that whenever you do an adjustment report, a prior period adjustment, a retro salary adjustment, or retro special comp, we're always going to use the rate now of the time that the service was earned. So for instance, if you'd go and do a prior period adjustment back to 2010, we're going to use the rate that was in effect at that time. So that's what the employer portion will be based on. That went into effect on January 1st. We didn't have the system updated, though, till January 19th. It went in, no problems. We did have an issue with one of the reports, the contribution detail report. Tim Herbeck's going to talk a little bit more about that when his section comes up. It's actually displaying the incorrect rate on the adjustments when you pull the report. It's always off by a small percentage. And that's because we are now deriving the rate opposed to just showing you what the rate is. It has to do with our known rounding issue we have. We're going to have that fixed. It's going to go hopefully into the May 10th release. So if you happen to notice that there's a small differential on the percentage, it's because of this known issue. Again, it should be fixed by May 10th. All right, now this one's kind of a big one. We've been working closely with our compensation review unit, and to help prevent bad data from entering the system, as well as also identifying employees that make higher pay rates, we're going to introduce 2 new business rules into the system. The first one I want to talk about is a pay rate threshold. So if you report an employee's pay rate, and it's between $20,000 and $30,000, there's going to be an error on that report. And it will be CRB 249. It's a brand new error code. It's essentially going to tell you that this pay rate is between $20,000 and $30,000 is going to ask you to verify that that indeed is the correct pay rate. And that will be all on the employer side. There will be a new panel. You will check the box that basically says that you verify it, resubmit your payroll, and it should post if there's no other errors. If it was reported an error, which in many cases, when our pay rate's that high, it is reported an error, you put the comma in the wrong spot, or you put a monthly salary as an hourly, you can just go in and correct that pay rate, resubmit, and that error should go away. We're hoping the majority of the things we catch with this will be because of those errors. But if it's a true, legitimate pay rate, you certify by checking that box. And then we have a second threshold as well. If it's over $30,000, you'll get a CRB 250. And that one will require not only that the agency or the district verify that that's a true pay rate, it'll require a compensation review unit to also verify it. So they will get in touch with whoever reported that and work with them to verify that that's a true pay rate. Again, though, if it was just a keying error, you can just go in, correct that pay rate, resubmit it, and it should post. So this will prevent us from getting a lot of bad data. We ran a report last year, and there were several agencies that had these astronomical pay rates, and it was majority of the times due to a keying error. So it makes it hard sometimes to do our evaluations and whatnot, knowing we have this bad data in here. So it should prevent a lot of that from happening. Plus, we'll do a lot of the front work for compensation review when they go to review a retiree's payroll for their pension. That is targeted to go into effect March 29th. We are going to send a circular out. In fact, I was just working on it the other day. Hopefully we get it out before the 29th. It's going to have screenshots that show you the new panel and give you more information about how this is all going to work. And then the last thing I want to talk about today is for the June release at the end of June, I think it was June 28th, we're going to now require for Classic members that you specify the category and type when you report special comp. Right now, we allow for unknown, but as of that date, we're going to require that you put the category and type in. So just like it works for the PEPRA and new members now, we're going to require that for Classic. There will be a circular letter for that as well. All right, so that's all I had for you today. Do you have any questions for me? Microphone, please. They should just give you a microphone. She always asks great questions, though, and I love her questions.
Okay, when for the classic member,
Yes.
how we have been reporting unknowns.
Mm-hmm.
So effective June, whenever the new release comes in, if we are making an adjustment to old unknown, so how will we do that?
That's a great question. So if you're going to reverse an unknown, we're going to still allow you to reverse it as unknown.
Okay, so you will allow.
Yeah, we're still working out the details on when you go to post back to an older date if we'll require the category type. We're leaning towards yes, but we also know that if you go really far back, you might not have the category type. So we're still working the details out on that, but we are going to allow you to reverse as unknown. Yes.
And second question is, I mean, it's not from here, but
Sure.
you know how the temporary upgrade pay, and in the forum, it was explained in a little more detail that how when a person changes complete position, let's say from technician to supervisor, for example,
Right.
when they are not doing their duties, only then it's reportable. And my question is, sometime at our districts, let's say the technician became supervisor, they just go to that salary schedule, let's say for 6 months, and pay that monthly pay rate of the supervisor to the technician.
Okay.
So in that case, how should that be handled?
Like how should it be reported? I'll see if Comp Review can help me out with that one.
That's okay. My name is Michelle Balsman. I'm the section manager over Comp Review. So to answer your question, when you do administer it that way, you're technically promoting that person into that position temporarily, and you can report that higher pay rate for them for that period of time. Right. So you wouldn't be reporting it as a special compensation item because you're increasing the pay rate.
Yeah, and that's how it.
Correct.
Thank you.
You're welcome.
Thanks, Michelle.
No problem.
I knew that. I just wasn't sure. I didn't. I actually didn't. Any other questions? All right. So be prepared for those changes when they come for the pay rate threshold. Again, circular should be coming out very soon. All right.
Thank you, Brad. You got off very easy. Thank you, Michelle, as well, for stepping up there. Okay, I'd like to have our next agenda item covered, and then we will take a break after that. So I'd like to invite Emily DeFlores and Lolita Luares to come on up and speak to us about overtime membership enrollment versus final comp. Thank you.
Thank you, Vina. You are too. Yes. So remember, if you guys want a break, we need to get out of here within 10 minutes, okay? Okay, so as we discussed last time, overtime situations are when somebody's working multiple part-time positions, but there could be a full-time position. We discussed how members need to be enrolled into membership for all qualifying positions. That still is true. You need to enroll all your members into CalPERS membership, even if they hold multiple positions. Once that happens, we do have system functionality that will give us the opportunity to mark the record that should not be reported with contributions to CalPERS on the enrollment screen. CalPERS staff does that review. We have had employers that have been emailing me so that I can give it to staff to review even before they start the reporting, that's fine. Again, the system has triggers and that notifies us as well. But then we got into a debate about service and final compensation. 20635 talks about that final compensation, whereas the laws that require you to enroll into membership are other laws. So the 20635.1 particular to schools talks about what's excluded in the final compensation. And so I have Lolita here who will discuss that portion because what had come up was Francis, I believe, was advised that that person had earned their year of service and they also worked the summer session. And I'm telling you guys, enroll them and report them. And Comp Review is saying, but it's not used in the retirement calc. That's correct. And so Lolita's going to speak to that end of it as far as final compensation versus CalPERS service credit and enrollment upon eligibility. Okay?
Okay, so I just wanted to go over the overtime statute that Emily mentioned, 20635.1, which is subject to the school employers. So that says that overtime is excluded from a member's final compensation calculation. That meaning if a member is working in a full-time position and there are any services rendered outside of their normal working schedule, we would render those overtime. It would not include those amounts in a final compensation calculation. So I believe there was an example given at the last meeting of a 10-month school employer or employee worked the full 10 months and may or may not have worked in a summer session. So in that example, because the member is a 10-month employee and they've received their full service credit because they completed their 10-month assignment and received full service credit, the services rendered in the summer school session would be rendered overtime for final compensation purposes and would not be used in the calculation of the retirement benefit. Now, from Emily's portion, she has stated that the payroll should be reported to the system. So we would see the lines of payroll in the system. However, they would be marked as non-contributory and there would be no service and no contributions attached to those lines. The system has the capability of not using those lines of payroll in calculating the final compensation. So yes, you will report them, but no, they will not be used in the calculation of benefits. We have some questions.
Okay, if they're non-contributory, do they have to be reported?
Definitely.
Yes.
And
So
what
you
is
have to enroll them
it?
and
They're enrolled.
you have to report them. And the reporting code is earned period, no contributions, and no service. That you use once we have identified the appointment as non-contributory. The reason being is this was added, a functionality added to the system because sometimes these employees don't work in the same district or don't work with the same employer. So when they leave one, the other one should begin reporting if they're still there. So we need to be able to ensure that we go back and communicate to the employer, hey, start reporting, because then there's going to be arrears.
Question. If the 10-month employee ends up getting docked for various out of sick leave, maternity leave, something like that, what happens then if their summer is not reported? They're not getting full service credit.
And I think that's the reasoning behind reporting these non-contributory lines, because we would be able to see that the member is not receiving full-time service credit for a particular year, and we would be able to go through and review the lines and see where the deficiency is and address it at that point.
Would you charge the employer then? Because a member could be gone by then for those contributions that.
Charge the employer what?
Well, for summer, if you decided, say, they didn't get their full service credit and you found out later that, you know, they worked summer school, and now maybe they could possibly qualify to have those contributions reported to give them the full service credit. Yeah, who would pay? Because you would probably find that out later. The employer would be not paying for it, and employee could say, I had that baby and now I've decided I'm quitting. I'm going to stay home with the baby.
So it
It
took me a
happens.
while to understand the question. So your question is, because they haven't paid contributions on that non-contributory appointment and they haven't earned their full year in that full-time position,
Right.
for the summertime that they did work, the contributions are still due employer and member.
Right. And then how would you would bill us later and then we'd pay it
So
all?
if you're asking if it would be under 20283, where the employer pays it all, it wouldn't, because you've already enrolled them. You've done that due diligence. It's when you don't enroll them within the 90 days that 20283 would then kick in and the employer would be responsible.
Would PERS then give them the full service credit or bill the employee? I'm just curious how that would work.
If at time of when this is encountered, then there could be an arrears calculation, a mandatory arrears calculation, which would go to the member. This is what you owe and this is why. And then the employer would be billed as well for their contributions.
Okay.
I'm just thinking what you said about the 10-month employee and when they have a summer job. I haven't thought this whole thing through. Isn't it districts might hire all employees 12 months? If they work 10 months, that's fine. But they're covered, so they're... I mean, is it better that districts should hire them for 12 months?
I think
All employees?
I don't know if I can answer your question
Yeah, no,
directly, but
I'm
I can say that if we look to the schools to let us know what the normal schedule is for a particular employee. So if this district does indicate that that employee is a 10, 11, or 12-month employee, we rely on you to let us know what their normal schedule is.
Yeah, what I'm saying is, isn't it in employees' benefit that districts hire them for 12 months, but whatever payroll they worked, so when the summer comes, in case they did do the job, they will get paid for that month, but when you call us, we will say they are 12-month employee. You know
Again,
what
I
I'm
can't
saying?
answer your question directly, but I will say we look to you to tell us what their normal schedule is.
Because other route is very difficult. Making adjustments, like Pam was just saying, that after 10 years we have to go and collect from employee. We don't even know where they are. So it would be safer for districts to hire everybody 12 months.
So if the district decides to hire them for 12 months, there's going to be payroll reporting for 12 months. And the benefits to that is the employee is going to have 12 months of pay rate to be used. Instead of for a 10-month employee, they have 10 months of pay rate divided by 12, which reduces that pay rate.
Yeah, but
So yes.
But it's a different pay
But it's
rate.
the
It's a
employer
different
who, the employer is the one that determines what their schedule is, what their employment time base is. We don't.
And what their pay rate is. So as Frances mentioned, she said the pay rates could be different between a 10-month and a 12-month employee. They may be working the same job. However, they have different pay rates because of the amount of time that they're performing those duties. We understand that, and we see that the annual rate is probably the same for if you calculated out the annual rate for that position. Just the time base is different, 10 months versus 12 months. And again, we look to you districts to determine what the actual time base is, 10, 11, 12 months.
This is just, I will give it to you after the meeting, but I had this employee from October 2013, has been paying into 2 different jobs, both monthly. We never heard from PERS until recently, like two months ago or something. And now PERS is saying, and the employee called PERS why I'm paying both places PERS into it. You know how you said
Yes.
you review for 3 months and we will get something. And now we have to go back and minus out everything from 2013 up to now. And then the email we got from PERS is saying to reverse everything. They didn't give us any way to report the line, just reverse contribution.
So if contributions were reported, we cannot update the enrollment screen non-contributory until the payroll gets reversed. Because if we were to mark the non-contributory, you could not reverse the payroll.
I get it.
So when
Okay.
you reverse the payroll,
Then we
then
will be
we'll go
able
out
to-
there. There's where that communication has
I
to
see.
happen. Tell us when you've reversed the payroll. Once all that's done, we'll mark it non-contributory, and then it can be reported as, what was it, earned period, no contributions, no service.
Emily, we have a question from the webcast audience, so I'll speak on behalf of them. So Nancy Lawrence from El Dorado County asks, are there any plans for PERS to issue a circular letter kind of clarifying this issue of 10 months and then the 11th and 12th being overtime, what's pensionable and such like that? Any plans on that line?
We can, but it's also in the reference guide, the public agency and schools reference guide.
So it's really not a new change or anything like that, it's just kind of,
No, we're just here to clarify the
Great.
differences that was created in the confusion in last SEAC meeting, where membership enrollment still has to occur, not contributions, but payroll data still needs to be reported to CalPERS. However, 20635 excludes that compensation for final compensation purposes. So the summer jobs should be reported. Again, all qualifying positions, you need to enroll them. And you need to report payroll as earned period, no contributions, no service. But again, when you guys know of this situation, what I've asked in the past is, feel free to email me. I'll send it to Taj. Taj will work with his staff. If it is an overtime situation, we will go ahead and mark it before you guys even start reporting payroll. That way you guys don't have to back out anything. We'll get that flag on there from the get-go, and then you guys can start reporting in this manner.
Okay, what happens if a 10-month employee isn't working 100% and they're
They-
working in the summer? So that wouldn't be considered overtime because they haven't put in 10 months worth of service because they may be working 50%, for instance.
So their payroll should be reflecting 50%.
So the
you
summer
report it-
then
so
it wouldn't be overtime though?
It wouldn't be over. So if they're working multiple part-time positions,
No, they're just working one job 10 months, but only at 50%.
so when you report it, they're not earning, in those 10 months, they're not earning their full-time service.
Correct. So summer
So
would not be
summer-
overtime then if they were to
Correct.
continue work. It would still be reportable
Correct.
time.
Correct.
Ramona Coker, Stanislaus COE. If I have an 8-hour-a-day employee, we report hourly. They work over the 10 months, 180 days, 8 hours a day. That doesn't get them a full year of credit. So if they work summer, do we take pension on that?
Should.
Yeah, so you're reporting up to full-time for all of your employees. Once you surpass they meet the 1-year service credit, they're meeting the full-time, that's when you would do the switch to the non-contributory, non-service.
Okay, what is it that constitutes full-time?
1,720 hours, 10 months. That would be the
215
minimum
days.
full-time.
215 days.
215 days.
Okay.
I have a question. So under the example you've shown, in order to be able to report those summer months for somebody who's, say, a 10-month salaried position who's full-time and earns that, and then in the summer works an hourly part-time position, in order to be able to report that as EPN Are you suggesting we do a separate appointment that would then be marked as overtime?
If it's a different position, yes.
If it's the same position, but they just get called in, say a custodian, they're salaried, regular, 10 months, but then during the summer they get called into sub or on-call?
Yes.
It would still need a separate appointment in order to be able to
Yes.
report it as EPN.
Correct.
Correct, is that what you're suggesting? But if we have that person.
But if it's the same, if it's the same job, they're just coming in during the summer for whatever, then it's the same position. If it's not the same position, then no. Let's say they work for you full-time, but they're asked to go to a different district during the summer. That's a different position.
Right. I'm looking at within our own internal organization. If we have ours set up as a 12-month, we're okay to continue reporting just on an hourly basis over the summer as they come in.
Correct.
Yes.
If you told us it was a 12-month employee and they worked 12 months, then we would see that as correct reporting, yes.
And that wouldn't be excluded from their final comp.
Correct.
Okay.
Great, why don't we go ahead and pause for our break now. So Emily and Lita, thank you very much. Any other questions that come in via webcast, email, or that you have, I'm sure Emily and Lita would be delighted to deal with offline. So let's adjourn for 10 minutes. I've got 10:47, so we'll resume at 10:57. Thank you.